Yeah, hello viewers. Good day, everyone. My name is Sunday. You are welcome to having Forex Academy. In the last video, I promised you guys that I'm going to be, dissecting the topics that I gave in the previous video. And I told us that learning Forex is a very, it's a long journey, but I will make it a very smooth and simple one for anyone who has been planning or who have always wanted to be a Forex trader, price action trader. Yes, I'm here to dissect some of the content that I shared in my previous video. Yeah, if you recall, we ran through the content of the things we are going to be discussing regarding how to start from the scratch and being a professional, a profitable Forex trader. We talked about Forex. Forex, everybody, when you hear that word Forex, people don't really know what it means. And I'm here to tell us that everyone has participated directly or indirectly in Forex trading, but you might not know. I will give you an example. Let's say, for instance, I will use myself as an example. I base here in Europe, where the currency here is called euro, and in America, the currency there is USD, that is the United States of America's dollar. The US dollar, as they will abbreviate it, the US dollar, Now, if I am to go on vacation to America, here we spend euro. That is a currency that we spend here. Now, I'm planning to go on vacation to the United States. What I will do, the currency that I have, which is the euro, if I like, as I get to the airport, before boarding a flight, what I will do is change some of my currency to the country that I'm going to, that is the United States of America. Or I can, at the point of arrival at the airport, I'll bring out some of my currency, which is the euro. I will then change it, because if I don't change it to their country currency, which is the USD, the United States dollar, I will not be able to buy things. For example, if I want to go to a supermarket to do shopping, or I want to go to restaurants to purchase, I want to relax myself to buy something, I cannot bring out euro. Yes, I have cash, which is my country currency, that is the euro. I cannot bring it out to buy something. Why? Because it's not a legal tender in their own country. So what I need to do is go to a place. You can go to a bank or in the airport at the point of arrival. You will see the exchange rate. If you want to buy, if I want to buy their own currency, which I'm as a visitor to the country, which means I am buying. I want to buy their currency, which is the USD. While I have euro as a currency with me in my pocket, in my wallet. So what I will now do is, okay, how much is the exchange rate? Now, forget about that word exchange rate so that, some people might not, get confused. Some people might get confused with the word exchange rate. I need to buy something and I don't have their country currency. What will I do? I go to a place. For example, for example, it could be a bank, or it could be um, um, an airport, or a point where they have bureau de change, where they do exchange rate. At the point of entry, the office or wherever they are doing the exchange, you will see it boldly displayed. If you are to buy XYZ dollar, this is the amount, this is the equivalent. If you want to sell XYZ dollar, that means they will be buying it from you. This is XYZ amount. Now, don't get confused. It's a very simple something. Okay, I want to buy because I need to spend money in the United States of America. I need to buy food, I need to do shopping, I need to even take buses, train, and all that. I need their country currency. So I will tell them, okay, I want to buy 500 euro worth of USD. They would show me the exchange rate. Don't bother about the amount. It fluctuates. It changes every minute. It changes every minute, I tell you. It's never stable. They will tell you, okay, this is the amount. If you bring 500, they will give you this XYZ USD. Then you give them your own country currency, which is the USD. I will give them my own country currency, which is the USD. They will give me the equivalent of that 500 euro as USD. Then I now collect it, put it in my wallet. What happened? We just did Forex trading. That is Forex trading. That is how to trade Forex. It's amazing, right? It's surprising. It's kind of something that you think you've never done before, but in actual sense, we have all participated, or so many of us have participated one way or the other. So now I have $500 in my wallet that I have exchanged. Mind you, the office where I did that exchange, they had 500 euro and $500 in with them. I came there, to buy that 500, to buy USD, euro worth of, to buy 500 US dollar worth of the euro that I'm holding, that I have. What now happened? The person selling to me has just made some profit. Yes, that is the truth. He has just made some profits because he will never sell it the same amount to me. He has just made some profit, but you don't know. Okay, you are the one buying, they are the one selling. They sold, I bought. He just made profit. Or the company just made profit. What you don't know, that is what we call exchange rate, is Forex. That is Forex. And now, let's say at the end of the day, I spend maybe my vacation period is over after 1 week, 2 weeks. I want to come back to my own country. What I need to do, I will check myself. The remaining dollar with me, what I will then do is, okay, I want to sell. I will check how much is dollar rate. I will not go and tell them, okay, I have XYZ amount to sell. They will not be the one buying from me. I will check the value as at that time I bought, and the value as at that time of the company selling to me. If the rate is higher now, that means me that I am now selling to them, I'm making profit. Now, the exchange rate at that time, when I bought, if it is now lower, they that are now buying from me, they've made profit. I don't want you to get confused. About the time I came into the country, I bought XYZ amount, right? Okay. After the time I now want to return back to my country, what I will now be doing, I am now selling. So the selling price as at that time, if it is higher, if the selling price is now higher today that I now want to sell, I'm making profit. But if it is lower, compared to that time I bought, if it is lower, I'm making losses. I hope you guys understand. That is how Forex trading is all about. One moment. That is how Forex trading is all about. And another thing is, what is Forex? Theoretical aspect, but I don't want to bore you with all those theories. Because the main thing is you practicing it, but just know what Forex is all about, what you have learned, you need to put it in practice. You need to put it in practice, because if you don't, there is no way you can be profitable. You learn, you go and put it in practice. As you progress, as you keep on practicing, you'll be making mistakes. As you make mistakes, and there's what we call back testing. Any trade you take in future, you write it down. The outcome of it, You note it down. At the end of 1 month period or 2 weeks period, you come back, that is back testing, you come back to check, okay, you did this. This is the reason why the trade went against you. Okay, I will not do it again. Okay, so there, I did this. Oh, I got it right. I got a profit. It actually hit my profit target, my TP. Don't worry, I will explain that later as we progress. Okay, that means if I do it like this next time, I will keep on being in profit. Okay, that is very good. You are simply doing what? Back testing. So, to recap, anything you have learned, you go put it in practice. Because as you progress, you are going to open a demo account which you will be using to do your practice day by day. You know, as you do your practice, you are going to be taking notes of all your trades. The ones that went against you, the one that you performed well, you are going to take records. That is what we call back testing in Forex trading. Now, what is Forex? Forex refers to the global electronic marketplace for international currencies and currency derivatives. You know, I will take it again. Forex refers to the global electronic marketplace for international currencies and currency derivatives. The point you have to note there is that it has no central, Forex trading has no central or physical location because everything is done electronically through you placing a trade to your broker. Your broker has a platform to perform the trade automatically. You to the broker, broker to the exchange, exchange to the broker, broker to you. So that is how it works. It's a very simple process. This thing I'm just saying to you now, it takes just one click. If you want to go in live, if you want to take trade, it's just a click. Just a click. Everything just, take effect. And as your trade progresses, you are seeing it live. If you hit your TP, that is your take profit, you are seeing it automatically to be executed. But if the trade go against you, it will hit what we call the stop loss. Don't worry about it. I will explain all these things. TPSL, that is the stop loss. I will explain all those things as we progress. It's something because stop loss, stop loss, stop loss, stop loss is a kind of protection that you put in place should this trade goes against me. Once it gets to this XYZ amount, the stop loss triggers. It cut off the trade. That means you are out of the trade. Instead of you to keep incurring losses, it will take you out. It will stop it. That is one beautiful thing about trading. Before you go in, before you even click the button, before you take entry, before you start a trade, you have already You have already determined what XYZ amount you are willing to lose if should the trade goes against you. That is why the business is so superb, to an extent that you can determine your loss. For instance, if you open a business, or somebody, let's just use a very common scenario. Somebody who sells egg, he has an egg shop, and is going to purchase eggs. You know how fragile eggs are, you know? He's going to purchase eggs. He just, you know, at the point of arrival, what the person does is just order, then he will load into his or her truck. Then he will not journey down. In that process, something can happen. Accident can occur. Almost, if not all the crates of egg, it can lose everything. Or at the point of arrival at that person's shop, the process of unloading the truck, some might get broken. Or before he finishes selling those things, he can incur loss. He does not know, he or she will never know how much you are going to lose upon that purchase, that particular purchase. But in Forex, before you even enter the trade, you determine what you are willing to lose should the trade goes against you. That is why we have what we call stop loss. And then we have the TP, which is the take profit. Take profit simply is a level where you want to take your profit. You set it. Once it gets there, it will trigger. You are out of the trade. You take your profit. If it's going against you, stop loss is a protection against your loss. Once it gets there, it triggers, you are out. So let's say, for example, your target is you want to make, let me just make it simple. You want to make $100 for this trade. Maybe a trade that will just be 5 minutes. You want to make $100. Now you now sit down and say, okay, should this trade goes against me, I want to lose only $20. You'll be the one to set it. So if instead of you losing $100 because you want to gain $100, you set the stop loss to be $20. Then your take profit, you set it to be $100. So if the trade, as you hit the button, maybe for example, if you are going long or short, all those things I will explain later, don't worry. If you are going long or short, or if you are buying or selling, if you hear the word long, means you are buying. If you hear the word short, means you are selling. So if you are going long, that is you are buying, as you take your entry, you see it going. The money, to be counting how much you have made or how much you are losing. So you set €20 to $20 as your loss, maximum loss. As the thing is going against you, once it gets to $20, it will cut. But even before it gets to $20, you can exit the trade automatically by yourself on your computer. You just place the mouse on the X button and you exit. And as the thing is going to your profit target. If you don't want to wait until it gets to 100, maybe it's already $60, and you just feel, okay, you are fine. You don't want to even wait, or it has already, gotten to $80. You exit, you take the 80, you are okay, you are gone under 3-5 minutes. So it's like that, depending on your time frame, though. So having said all of that, the point we need to note is it has no central or physical location. It's done electronically, electronically. You're at home, you are a trader, you place a trade to your broker to the exchange, your exchange to the broker to you, the retailer. That's all. Everything work electronically. We all know that forex market is one of the most liquid market in the world by trading volumes, meaning the amount of the amount of trades per day. Forex markets worth trillions of dollars changing hands daily. Trillions of dollars daily, on a daily basis. That is how volume the market is. People sit at their homes, their offices, because it's not just individuals that are doing it. Banks, they do forex. Government, they do forex. Institutions, they do forex. So it's one of the best things that anybody can do at your own convenience. It's just for you to set your computer, take an entry, put your stop loss target. You close your computer, you go to work, or you go and play football, or you go on a bike ride, or you just take your car, drive out, go to a restaurant, or go to any joint and relax. When you hit your take profit, you will see it. As you go, you check your phone. Or if you don't want to even let that bother you, don't forget about it. Once you hit your take profit, it will give you a lot. Once you hit your stop loss, it will give you a lot, so you will know. So you don't need to worry. Once you take your entry, set your stop loss, your target, because stop loss is, after entry, is stop loss, because stop loss is a protection. Is a protection. Should the trade go against you, you set a stop loss. Immediately as you take entry, you take stop loss, then target. That's how it goes. Whichever way, either you are going long or you are going short, you are buying or selling. So it's like that. Like I said, it worth trillions of dollars changing hands daily. That is how liquid forex market is on a daily basis, 24 hours, 5 days a week. Most tradings are done through banks, institutions, brokers, individuals, even governments. They trade, banks trade, government trade. Government has a body that trades for them because it's a big business. Because why is government involved? Government is involved because if a country's currency is over rising, it becomes problem. If the currency is over rising, what will now happen is banks, the central banks of the country will now pump in money to bring it to a certain level. Don't worry, as we progress, I'm going to be throwing more light on all that. If the currency of a particular country is too low, it's not good for investors. What will now happen is the central bank of that country will pump in money to bring it up, to bring up the currency. So that is why government of a country is involved in trading in forex trading. Market is open to business 24 hours, like I said, 5 days a week. And we have sessions, different sessions. We have the London and Europe session, we have the New York session, we have the Sydney session, and we have the Asia section. Those are the 4 sections that we have, you know. And the London session opens 8 o'clock, 8 a.m. to 4 p.m. The New York session opens 1 p.m. to 9 p.m. The Sydney session opens 10 p.m. to 6 a.m. Then the Asia session opens midnight to 8 a.m. So you can see it's round the clock. Whichever session you prefer, you do your trading. Anytime you want, if you sleep, wake up, you can do your trading. If you go to work, come back, you can do your trade anytime. Anytime. If your day-to-day job does not allow you to trade daytime, at night, or maybe when you return from work, you just do your analysis, then place a trade, go and sleep. 1 hour is okay. Place a trade, allow the system to do the remaining ones, that's all. But as a beginner, you need to spend some time. That is, the way you can learn faster, because you have to spend some time looking at the chart, how the candlesticks prints, the anatomy of the candlesticks, the how price reacts, the behaviors, and all that. You need to spend time. But by the time you are advanced, then you don't need to spend much time anymore. Maybe 20 minutes, do your analysis, place a trade. Or you can even put you can even place a trade. You are not really in the market. Set a trade that, should the price rise up to this place, trigger me in. It's a very nice business and very, very interesting one. That is, if you want to buy, after your analysis, maybe after your analysis, you will say, okay, should this currency rise up to this point, trigger me in, I'll be in a long trade. Or you want to go long, you want to go short, you want to sell. Okay, this thing is high like this, but with my analysis, I feel it will come down to this point. With my analysis, I feel that after this height, after this level, it will come down, it will decelerate. So by the time it gets to this point, it's here. But by the time it gets to this point, trigger me in. I want to go short. So that is, in Forex, we have what we call buy stop and sell stop. So all those things are systems that will enable you place a trade, even though you are not particularly in that trade, you are not triggered in instantly, but you can set everything down. By the time price drops to that level, the system will trigger you in. Or by the time price go high to that level, when you want to go long, the system will trigger you in. So that is why we have the buy stop and the sell stop. All those things will be well explained as we progress, as we go on. Now, One moment. I tell you guys, this is a business that anybody can do because it does not require more. You don't need an office. You don't need plenty money to start. All you need is you can start with your phone. If you have an iPhone or Android phone, provided you have an internet, all you just need to do is you download the software, register with a broker. As we go on, I will tell you how you are going to register with a broker. Register with a broker of your choice. Then, from your broker's platform, you now link to the platform. Most brokers, they offer a platform, but there are more advanced and very easy to use because of the tools in other platforms that people, instead of using their broker platform, they have a particular platform that we all use. For example, MetaTrader 4. MetaTrader 4 is a platform that most traders use because of the tool and the interactive face is the interactive interface is user friendly. And if you don't like MetaTrader 4, there is other one that I use that is the best. I'm not saying MetaTrader 4 is not good, but TradingView is called TradingView. TradingView is better because of it's user friendly and the tools are superb. The tools are superb, very easy to use. So all you need to do is register with a broker. From your broker, you link to a platform where you perform your day-to-day activities. Okay, the first, you must have an account with your broker. As a beginner, all you need to do is open a demo account where the broker will fund your account, but you can't withdraw it. It's not your money. As a matter of fact, it's a paper money because it's a paper money. You are using a paper money to trade life because you are going to be using that to practice. You're going to be using that to practice because you will lose because you don't know. Just like somebody, you have a son or a daughter and he's grown, maybe he just graduated or it's your daughter or your son's birthday, and you just say, okay, let me just surprise the child. What you need to do, okay, you just go to a car shop, purchase a car, bring it down, and that your child, you know that he or she does not even know how to drive. Purchase a new car on his or her birthday, you just, give us a gift, give him or her as a gift. Do you expect someone who does not know how to drive, because you have the money to buy your child a new car? The child, will you just allow that child to just hop in and start driving the car? Because you just purchased it for your child and the car is new, and because it's now his own or her own, the child will just jump in and start driving. He will just go and die and destroy even the car, the new car. So before the child can start driving, he has to go to driving school. He or she must learn how to drive. And apart from learning how to drive, he need to practice after learning how to drive. He or she needs to practice. And as a matter of fact, the new car is not even suitable for learning because in the process, it can scratch and rubbish the car. So the new car is not suitable for that purpose. So in Forex, what normally happens is the first thing you need to do is to create account with your broker. We call it demo account. So you'll be demo trading in a live trading environment. But anything you lose or gain, you cannot withdraw it. Even if you are making profit, if you are smart enough and you are making profit, let's say you are good, you are making profit, you cannot withdraw it. It's not your money, it's the broker's money. But even though it's the broker's money, it's a paper money. It's allowed for demo trading. When you hear the word demo trading, if it's confusing you, don't worry. Demo trading simply means you are using that account with the money, maybe $50,000 account, to be practicing, because you will lose. You'll just be losing the money because you don't know how to navigate the market. You are not grounded technically, so you will definitely lose, even blow the account, lose the whole $50,000. Once you lose it, you call them, they will credit you back, then you start practicing. It is only when you now see that $50,000, you now turn that $50,000 to $100,000. From $100,000 to $120,000. You are seeing it. How? Or when you now see that you are making profit consistently, I beg your pardon, when you are consistent in making profit, you will now know that, okay, I can now open a live account, still keeping that demo account, open a live account, then you will now pay in some amount. Maybe if you want to own leverage, there's what we call leverage, all those things. Before it takes time before you get to that level. I'm just trying to give you some insights, So the money you will now put, maybe for example, the $50,000 account that you want to be using, your own money that will be inside will just be $500 for you to have 50,000 worth of an account, real money. So all you need to do, you deposit $500. They will put $45,000, making $50,000 in your account. That is how it works. But meanwhile, as you are trading, you cannot trade above that your $500. That is it. You cannot trade above that your $500. Because they are using that $45,000 plus your $500, making $50 to hold a position for you. But by the time you start trading, there's what we call lot sizes. So if you are to place a trade, you have to calculate it before you place a trade. All these things I will teach you as we progress. So at the end of the day, once you lose up to 500 euro, you will not be able to trade anymore until you put another 500. But if you are good, you can multiply that money. Once the money that is $50,000, if you multiply it to be $51,000, you can withdraw that $1,000. You withdraw it, and you still have your $50 intact. You withdraw it. You withdraw the $1,000, or you can withdraw $500. That means you now have $1,000 as your own inside. So that is how it works. With leverage, you can own an account, even $100,000. If you have 1,000 euro, sorry, that is my country currency. If I mention euro, don't need to get offended. If you have $1,000, Maybe in your account, you pay in $1,000. I'm not saying you should go and pay $1,000 or you should go and deposit $1,000. But maybe you have the money, you go deposited $1,000. You can own an account worth of 100,000 euro. It makes sense? So let's continue. That is what we call leverage. Leverage helps you to own an account, by depositing just maybe 5% to own 100% lot size. So that is why we have brokers, because they have money and they need people to help them trade, because they are making commission from each trade that you place. It's a very small margin. So that is just how it works. Then introduction to, now that we know what Forex is all about, we know how the time, the sections for trading Forex, and we know that Forex is not a centralized something that, tomorrow they will not say the office closes. No, or the system has crashed. No, it's not a centralized place, meaning that it does not have, this is an office. If the office goes down, that means everybody knows. It works electronically. Even if there is crisis, anything, in fact, that is even the time people are making money. That is just how it is. We now know how the sections on how to trade. We have the London Europe session, the New York session, we have the Sydney session, and then we have the Asia section, And now I want to introduce you to what we call candlesticks. The candlestick trading is one of the most powerful trading systems in history, because candlesticks is what you'll be seeing on the chart. You'll be seeing candlesticks. Each candlestick, depending on the time frame, because we have 1 minute, we have the 2 minutes, we have 3 minutes, we have 5 minutes, we have 15 minutes, we have the 10 minutes, we have 1 minute to 10 minutes, 15 minutes, we have the 30 minutes, we have 1 hour, we have 2 hours, we have the 3 hours, we have the 4 hours, we have the daily, we have the weekly, we have the monthly. So all this, we call it, is what we call time frame. So each candlestick represents time frame. Let's say, for example, I'm on a 5 minutes chart. 5 minutes is my time frame. That is where I use to execute my trade. That means 5 minutes is my time frame. If your time frame is 15 minutes, that means 15 minutes is your time frame. So any trade you place, each candle will be fully printed in 15 minutes. Even if the candle is small like this, it printed small like this, because that is where we have different type of candles, and they all have meanings. They represent something. They represent the fluctuation of the currency, how currencies move up and down. So if the candle print full like this, one moment, I need to plug my laptop. Oh, sorry about that. Is the battery. I didn't put the charger, you know. So as I was saying, if each candle represents a time frame. So it takes, if I'm a 5 minutes chart, it takes 5 minutes for one candle to be fully printed. Once that candle is fully printed, after the 5 minutes, another candle will start printing. Make sense? Okay. So we should not dwell on that too much. Candles, like I said, candlesticks trading is one of the most powerful trading systems in history. It was invented by a man called Homer Monanissa. Homer Monanissa, that is the man's name. We call him the father of candlesticks chart patterns. This trader is considered to be the most successful trader in history. He was known as the god of markets in his days. His discovery made him more than $10 billion in today's forex market. And the man called Homer Munehisa spent over 10 years compiling, testing, organizing, consistently updating this method to create easiest and most profitable trading system. The candlestick trading is a trading method that is going to, this candlestick trading is a trading method that is going to finally take your trading to where it should be for you to be consistent, profitable, easy, and requiring very little time and effort. When you follow this system, it requires just little time and effort, and you'll be profitable. This trading system is based on Japanese candle, which I've just said earlier. They call it Japanese candle. In combination with, it uses candlestick patterns in combination with technical analysis. All what you have to do is to spend as much time as you can to master the method, that I'm going to be sharing with you, and use it to trade this financial market. That is the forex market. If we say forex market, financial market is the same thing, because in financial market you trade even stocks, indices, cryptos, and all that. When you learn these candlesticks, the candles that represent prices and all that, it's like learning a new language. It's hard. But when you put in effort, you will just see yourself going through the process. And before you know it, from the basis, you become a professional, a profitable trader. Like me, I started very roughly. I didn't even have anybody that is, teaching me, coaching me until I found somebody, I don't want to mention his name. I paid for this course. But I bet you what I observe is people giving you, overloading you with theoretical aspect. But the practical, which is the most important thing in trading, in forex trading, you will be the one to navigate it yourself. You'll be the one to do everything yourself. But I thank my mentor, because it's a good guy. The guy is based in US, Anytime I have questions, I will always contact him. He's always there to put me through. You know, it's like that. You must have somebody that will always, put you through, because he has gone through that same process. So for it to be more easy, because for you to be a trader is not an easy job. It's not an easy something to learn, but having a mentorship, it will make it more easier for you on the journey. So it's just like learning a new language, because you have to be reading those candles. Those candles, they're the one that is representing the price actions, how the price fluctuates, how the bulls and the bears are rallying. The price wants to go up, because in Forex, we have just two things that is going on there: the buyers and the sellers. The buyers are pushing the price up, the sellers are pushing the price down. That is the war there. Now, how do you determine that, okay, the buyers will break and take over to push the price higher to a particular level, to a certain level? Or how do you now determine that, oh, as they are struggling now, the sellers will push the price down to this level? That is the forex we are talking about. The ability for you to say at every time that, okay, this trade is supposed to go up. That means you want to go long, you want to buy. If you are seeing price, oh, this price is supposed to come down, after your analysis, after all the confluences, if you now arrive at a point, at a conclusion that, okay, the price is supposed to come down, what will now happen? You go short. So either ways, as you sell, as you buy, you make profit. As the market is going down, you sell, you make profit. The only way you make loss is when you say, okay, this thing is supposed to go, after an analysis, your conclusion tells you that, okay, you are supposed to go long. That means you are supposed to buy. And when you now place a trade, a buying trade, you now see the trade revert is going down. So that means your analysis is wrong. That is where you make loss. And for you to quickly stop that loss, that is why we have stop loss. You remember, stop loss is a protection against your trade. Should your trade go against you, that is a protection. So, like I said, what is really happening in the forex market is buying and selling. Each candle represents one candle represents buyers, this other candle represents sellers. So if the market is going down, that is a selling opportunity. Now you see a red candle. We have two types of candle. The green represents buyer. That is a bullish candle. We have the red, which is the bear candle, which represents the selling candle. That is we have the bullish and the bearish candle. The bullish and the bearish candle. That is how it is. Buyers and sellers. Green and red. But you can change. By the time you advance, you can change the candle to any type of color you want. But the common color code is the green and red candle. The green represents buyers. The red represents the seller. So that is how it is. Now, candlestick anatomy. Just as humans, candlesticks have different body sizes. This candlestick has different body sizes. And when it comes to trading, it is important to check out the bodies of candlesticks and understand the psychology behind it. Psychology in trading is another course on its own, because psychology, because once you place a trade, the psychology for you to be able to leave the trade to run, for you not to cut your profit early, or for you to be able to cut your losses early, even though you have a stop loss in place. Like me, for example, with my level now, once I do my analysis and all that, I place my trade. If I'm seated in the front of my system, once there's a reversal going against me, once I see a particular candle printed, I will just know that that is a reversal candle. That means if I'm going long, if I place a buy trade, and I now see after 5 minutes, if I'm on 5 minute time frame, after 5 minutes, one candle has already printed. I now see by the time the candle is fully printed, should the candle gives me a particular printout of a candle, a pattern, I'll just know that that is a reversal candle. What I will do is just cut my loss, just go out of the trade and follow the trend. Because as they say, trend is our friend. If you go against the trend, you are in trouble. So it's better you follow the trend. It's just like a moving train. If you stand in front of a moving train, it will put you down. But if you're at the back, just hop in the train, you just be going in the direction of the train. So trend is our friend as a price action trader. Trend is our friend, and that is what you need to always identify. That is why we have the technical analysis, we have sentimental analysis, and we have the fundamental analysis. Those analyses with other confluences, once you're able to use them correctly, you don't have any problem. I'm telling you. So like I said, candles have different body and sizes. And when it comes to trading, it is important to check out the bodies of candlesticks and understand the psychology behind it. That is what we are going to learn as we progresses. Then the candlestick patterns. Candlestick patterns are an integral part of technical analysis. Candlestick patterns emerge because human actions and reactions are patterned and constantly repeated. The human actions and their reactions, they're always patterned in the same way because it repeats over time. In this session, we will learn how to recognize the most important candlestick patterns. Like I said, once I see a candle, I know that that is a reversal candle or a continuation candle or a dodgy candle, indecision candle, or a morning star, evening star, or a bullish engulfing, bearish engulfing, name it, or double tops. Once I see all those things, all those patterns, I will just know what it means. I don't need anybody to tell. Once I watch my chart, I see all those things, I know what I need to do immediately. If I'm wrong, I'll just correct it. So let's say, for example, all my analysis, and after my conclusion, I now discover that, oh, place a trade, I'm wrong. My stop loss is maybe 50 euro. I said 50 euro as well. Let me lose 50 euro if I'm wrong. But if I'm right, let me gain 150 euro, for example, because everything is based on ratios. If you want to place a trade, your risk, your profit must be twice, minimum twice your risk. That is how we trade. Your profit should be twice your risk. That is 2 risk reward ratio. If I'm to set my stop loss to be 50, that means, for example, let me just bring it down. If I am to place a trade and my stop loss is at 50 euro, let me lose 50 euro if I'm wrong. Then my take profit should be 100 and my take profit should be 100 euro. Make sense? That's, we call it 2 to 1. If I'm right, I gain twice. If I'm wrong, I lose 1. That is the standard. Because why is it like that? Let me explain. Let's say you place 5 trades in a week. You're able to trade 5 times in a week. And out of that 5 times, you lose 3 times. Your stop loss is always on 50 because you need to be consistent. You need to be consistent in anything you do. If your stop loss is always at 50, or we call it 20 pips, for example, I will share with you later on as we go on. Your stop loss, 50 euro. Your target, 100 euro. And you're able to execute 5 trades in a week. And you lose 3 trades out of that 5. And you win 2 trades. So your 2 trade is what? 200 euro, right? Then the 3 trades that you lost, the score is 150. Are you losing or you are in profit? You are in profit. You still have 50 euro. But you lost 3 out of 5, but you are still in profit. That is the beauty of trading. Let's now assume let's reverse the table. You have 5, you were able to execute 5 trades, and you're able to hit your TP, that is your take profit, 3 times. And in a week, you just executed 5 trades. You lost 2. You lost 2, that is 100 euro that you lost. The remaining 3, that is 300. Remove 100 from 300, you still have 200 as profit. That is it. It's like that. As simple as that. So anytime you want to take trade, you want to place a trade, you must set a standard. 2 to 1. That is the ratio. 2 to 1. What is 2 to 1? Your stop loss 50, your TP 100. As simple as that. So another thing is the market structure. All those things, we are going to delve into it in details. We have the market structure, you know, how to identify trend markets, when market is trending, when market is ranging, and a copy market. I will teach you on how to identify those, how to identify trends, how to know the type of market, because we have trending market, ranging market, copy market. Okay. I'll also teach you how to draw support and resistance, the point of support resistance, you know. You do know why candlesticks are important? Candlesticks they are important in our analysis because it is considered as a visual representation of what is going on in the market. Like I said, candlesticks represent the transaction that is ongoing. You see the candlestick printed to be going on, sometimes it will be coming down. It's like that. It will close small like this, a Dolce candle. It will close like this with a pin bar. It will close full engulfing candle like that. So many. Just by looking at the candlestick, we can get valuable information about the open, high, low, and close of price, which will give us an idea about the price movement. Candlesticks are flexible. They can be used alone or in combination with technical analysis tools such as the moving averages. All those ones are indicators. When you see a candlestick like this, then you know what it means. But for you to be very sure, you need more confirmation, you need more confluences. What you need to do is bring out, like your platform, those tools are there. You just bring out indicators like moving average to see, or Fibonacci to see, for you to, those are more confirmations. So you need all those tools as time goes on. Like we have what we call momentum oscillators as well. All those are indicators. They can be used also with methods such the down theory or the Elliott wave theories. All these are indicators. You will see them by the time you start practicing. Like me, I personally use candlesticks with support and resistance, trend lines, and other technical tools that are already on that platform. But you need to know how to use them. When we get to that, we are going to dissect everything. The human behavior in relation to money is always dominated by fear, greed, and hope. Candlestick analysis will help us understand these changing psychological factors by showing us how buyers and sellers interact with each other. Point to note, candlesticks provide more valuable information than bar charts. Using them is a win-win situation. If you are very perfect, candlesticks, once you see a candlestick, you know what it means. If it is a reversal, continuation, or what do they call it again? Or consolidation. You will know that the market is consolidating. It's resting. Let me put it that way. It's resting before you now decide where to go. Indecision candle, that is a dodgy candle. That means both the buyers and the sellers, they are deciding. They are in equilibrium. No one has taken over the momentum. So once you see it, you know that the buyers and the sellers, they are at equilibrium. Once you see another candle, you know that the buyers has taken over. All the sellers has taken over. What is a candlestick? Candlesticks are formed using the open high, low, and close off the choosing time frame, like I explained. We have a candle like this, candlesticks. Let's use this silver point up and down, silver point up and down. Here is the upper shadow. Here is the down shadow. While this color is the body. Let's use it as an example. Here is the high. This place is the high. This is the low. This is the open. This is the open where the silver stops. This is the open. It grows, it prints up to this place. This is the close. But when it's like this, if you open low and close high, it is called a bullish candle. That is a green candle. Now, for the bearish candle, this one I just explained now, it represents buyers in the market, people who are buying. If it opens low and close high, that is a bullish candle. That is a buyer candle. Then the bearish candle, that is a seller's candle, it will open high. Reverse is the case now. It will open high, close low. So it's going down. The buyer's candle is going up. It opens down, it closes up. Then the sellers opened from the top and close at the bottom. Make sense? Then this one is called the upper shadow, while this one is called the down shadow. This is the open and this is the low. That is how candlesticks are. If the close is above the open, as I have just mentioned, we can say that the candle is bullish. If the close is above the open, that means the open from the down, it closed from the up. We say the candlestick is bullish, which means that the market is rising in this period of time. Bullish candlesticks are always displayed as green candlesticks. If the close is below the open, we say the candlestick is bearish. That is seller, which indicates that the market is falling in this section. Like I said, bearish candlesticks are always red. But as you get more advanced, you can change the color of candle. It's your own. But the common color is the green and red. But as time goes on, you can change your color. You can change the color to your own. You can change it to white or black, just for you to be able to recognize them. And that's all. Candlesticks body sizes. Candlesticks have different body sizes. The long and the short body. Long bodies refers to strong buying or selling pressure. If there is a candlestick in which the close is above the open with a long body, this indicates that buyers are stronger and they are taking control of the market during this period of time. In the same way, if a bullish candlestick in which if a bearish candlestick in which the open is above the close with a long body, this means that the selling pressure controls the market during that time frame. Short and small bodies candle indicate a little buying or selling activity. Where you see is like all those short and small candles, we usually call them a decision candle. Candlestick shadows or the tails, as we can call it the tails, the upper and lower shadows gives us information about the trading session. Upper shadow signifies the session high. The shadow, or we call it wick, this silver place. Session high, session low, session low, session high. Make sense? Upper shadow signifies the session high, lower shadow signifies the session low. Candlestick with long shadows shows that trading or action occurred well past the open and close. These candles, I'm using this as a candlestick. It can start open here, print up to this point. But before that 5-minute time frame closes, or whichever time frame you are, it can push a little down. It has already gotten to this point, but it can come down a little to this point. You understand? It can come down again, but it will now be left with the wick. Right? So that is how it is. Yeah, guys, at this point, we are going to pause for now. We are going to, end this teaching for now, and we continue next time so that too much of information overload is not, really advisable because it's most of the theory aspect. For now, I don't want to bore you with theory. I know we'll get to the practical aspect, which I'll be sharing the screen with you, and you will see the illustrations and all that. Okay? Yes, thank you for the time, and remember, this is Harvard Forex, and my name is Sunday. This knowledge I'm sharing is free, okay? But the only thing I want you to do to support me is to hit the like button, share my video, okay? And I promise you that as we progress, I'm going to be keeping it very real and simple for you to understand how it works, for you to understand the entire financial market. It's real, man. It's something that anybody can do. All you need is your laptop. If you cannot afford laptop for now, your iPhone or your Android that you are just taking up and down, you can be using it to earn a living, even while you are working. All you need to do is place a trade. Your phone is in your pocket. You go to your normal work. Once you hit your take profit, you're already in profit. But if it goes against you, it takes you out because you have a stop loss, you have a take profit. Entry, stop loss, target. It's like that. It's a very simple, guys. If you have any comment, put it in the comment section. And if you have anything that you want me to clarify, if you don't want to put any message in the comment section, you have my email address. Email me, then we'll trash it out one-on-one. And if you need personal coaching, for me to coach you personally, you want me to coach you personally one-on-one, that you'll be live with me on video. We'll be talking and I'll be putting you through, sharing my camera, my screen with you. Email me, let's talk. All right? Okay, thank you guys for your time, and enjoy the rest of your day.